Hi, I'm Suzanne with eXp Realty.
Hey, I'm Sean Cutchins. I'm Senior Loan Officer with People's Home Equity.
Hey, Jason Black, Transaction Coordinator with People's Home Equity. And we've got all the facets of a mortgage transaction covered here. And we're looking forward to talking to you about your credit score today.
Awesome. So everybody, I'm sure, wants to know about boosting your credit. And so as Homer's letting us know, we want to talk about ranges, not mountain ranges, but the ranges of your score. And I think it's important to understand, how does that work? So if you look at our next slide, you can see this is the way that a score is reviewed. You've got everything from 850 all the way down to 300. Now, I don't know about you, Jason. I've never seen a 300. And I would say that that would be quite an interesting bureau to review. But as far as the typical credit scores that we see, they're generally going to be the ones between 670 and 739. When you get above that 720, 740, that's where you're going to get your more premium rates. And, doesn't mean that your 670 and above doesn't get a good rate. You just get a little bit of a discount when you're in that 25% window. But overall, this gives you a picture of how do most credit scores break down the country? Where do you stand and where do you have the potential to go? So.
And I just wondered, as a first-time buyer or buying a second home even, does it mean that I have to wait until I hit the 670 to be able to get into a mortgage?
No, that's a great question. I think a lot of people, it's funny, I've talked to people at times and I'll say, do you know anything about your credit score? And they'll tell me, well, I don't really have that good of a score. I don't think I can qualify. And I'll say, well, what kind of score do you think you have right now? And, they'll say, well, I have like a 620. Well, we absolutely can get a 620 done. We can get a 580 done. You can do as low as 560 if you have the right amount of money down through FHA, but a typical FHA starts at 580. And it is funny because people's views, because of what they've been told, change. Someone might think that they don't have a good credit score and they've actually got more than a qualifying credit score. Some people think their credit score is outstanding, and it's not probably what they think it is. So I think that's ultimately where you need to get with somebody who can help you run through it, take a look at it. And, that's part of what we want to discuss today is if it's not where you want it to be, how do we help you get it to that next level?
I have heard about Credit Karma and how it can make your score seem different than what it really is.
Yeah, and that's one place where you have to really be careful. That's a great question, Suzanne, because Credit Karma, ID Alert, different places like that, they use a different scoring model, and it can be very deceiving. I get a lot of clients that will tell me I was on Credit Karma and my credit score was a 720. And when we pull it, their average credit score is a 680. And it's just because they don't use all the qualifications that we have to use when it comes to a 3 bureau, which is Experian, TransUnion, and Equifax. All 3 of those get pulled. And so, again, that's where you want to get with your mortgage professional and really figure out what's going on.
I see.
Awesome.
Mhm.
All right.
Yeah, and on that note, kind of diving into what goes into that, and what's the algorithm looking at when it kicks out that score on a daily basis. Before I dive into that, I want to ask you guys, since you guys are on the front end, how often are you getting questions around, what makes up a credit score?
I will tell you, obviously, being a loan officer, I get it all the time. But the funnier part for me is, and I know I'm in trouble, Jason, when someone says, well, my cousin told me, I'm thinking, oh, here we go. The cousin's the mortgage expert, and they'll tell you all kinds of crazy stuff about what makes up your credit or how to boost it. So again, you'll hear me reiterate, that's where you got to get somebody that knows what they're doing, right? I know nothing about cars, which is why I go to a mechanic. There's a lot that's involved in this and you can learn a lot, but if you really want to know where you're at and how to get there and what's involved in your credit score, get with your mortgage professional.
Absolutely. And, some of the things that I thought was really interesting about this is, looking at that 850 on the slide above, it's everybody starts with that 850 every day. And then they run these things through. So your payment history makes up 35%. The amount owed and revolving utilization is 30%. Length of history is 15%. Types of credit is 10%. And the new accounts are 10%. So after your information's ran through that algorithm, your score is adjusted from an 850 to whatever the final score is. And another really neat thing is after you've seen a billion credit reports, is the credit report will actually tell you on the report, is it overutilized? What's going on? Too much new credit, too many active accounts, things like that. It'll actually tell you why your score isn't an 850.
That's pretty awesome.
I've heard some things about medical and student loans, that's going to make some changes about your credit in the future.
Absolutely. So there was some real big news about mid-year last year when they came out and the CFPB said they were going to wipe away. I think it was billions in medical debt nationwide, and then it was going to get to a point to where they're not going to report any medical collections under $500. And those things are still in the work, and that's going to be a massive overhaul. And along with the student loan thing too, those things are still in the pipeline. It is big news because everybody's got a medical collection. You go to the doctor and you get a bill from everybody, the triage, the nurse, the doctor, the janitor. Everybody sends you your individual bill, and then when you miss one of those, you've got a medical collection. And fortunately, as we stand now, those don't report as badly as other major derogatories, like for instance, a power bill or something like that makes it on there. But there is some good stuff in the pipeline that's going to kind of level the playing field for some people.
I think that will help a lot of buyers out. Yes.
Absolutely.
All right, so let's talk a little bit about inquiries. I think there's a lot of misconceptions about inquiries. One misconception, Jason, I know that I hear all the time is I don't want multiple mortgage inquiries on my credit bureau. What people don't realize is that if you do a mortgage inquiry, you have 30 days that, as long as it's a legitimate mortgage inquiry, it only counts as one overall inquiry. Then, when you look, most of your inquiries only impact your credit for about 12 months. Then when you think about what is it that the inquiries impact, well, as long as it's not been within the last 90 days, really, there's not a whole lot that it's going to impact. The last 90 days, we're going to want to know, was there an account opened up? Because obviously that impacts things like your debt to income ratio, which is how much do you make and how much are you spending? And so when sometimes those things get tight, those inquiries let us know whether or not there was any additional debt opened up. But overall, where you got to be careful is when you're ready to go and apply for a mortgage and you're getting close, that's the time to not go get the 10% off on your next purchase, at Belk, because they're going to offer you a credit card. That's the time where you don't want to open up any new debt and take a chance of changing the parameters of the loan. But as far as overall inquiries, I think if you can make sure that, you keep them to a minimum, and then at 90 days, really kind of stop inquiring about other credit, it doesn't really impact you as much maybe as you think.
Yeah, and I can tell you from personal experience, after being in banking for a little while, and seeing how much of a need there was really for guidance around credit, I dug into it, and I had a manager that bought me a book, and I got into writing some of the letters that people write to the bureaus, and one of the things I was writing those letters about was inquiries, to help them get inquiries removed. And I was just so on fire for it. But once I realized how insignificant the impact was, I realized that it wasn't worth the amount of time it was taking for me and the client to put those letters together, fax them to the credit bureaus, because it was so insignificant.
Gotcha. Makes sense too. All right, let's talk about closed-end credit and open-end credit. What is closed-end credit? So closed-end credit is going to be a fixed payment period. You have X number of payments for X number of time, and then the loan goes away. Okay. It's typically going to be a fixed rate. Then you have your open-end credit, which is going to be, you borrow against it, you use it again. You borrow against it, you use it again. It's yours until you either close it out, or if you're not using it correctly, sometimes they'll close it out. But, typically it's going to be some type of line. It's going to have an annual fee, and it's going to have an adjustable rate. But those are your two types of credit when you talk about credit mix, your open end and your closed end. So
Could you maybe give me an example of an open and a closed credit?
yeah, awesome. And sometimes that does make it easier. So if you think about a closed end, you think about a car payment. I'm going to buy a car. I have a $30,000. Of course, I don't know any cars right now you can buy for $30,000. Based on what I'm seeing, Jason, you got a $70,000 loan. You got a $550 payment. You pay it for 72 months and it's done. You don't get to use it anymore. It's just one time, a house payment closed in. Where open end is going to be typically your most popular open end are your credit cards, right? You get a credit card. It has a line of credit. You borrow against it. You pay it down. You borrow against it. You pay it down. And open end credit is kind of the one that really will, you got to be the most careful with. And I know we're going to touch on that in a minute, but that's the one that a lot of times people don't realize how the open end aspect of it can impact you. So we'll cover that in just a second.
Absolutely. And that kind of works us right into length of credit and average credit age. And a lot of people don't realize that that's a factor and what goes into that. And kind of talking about, so you say you've got a 72-month auto loan. Well, at the end of that 72 months, this might report for a little while, but it's no longer an active account. So that's going to go away. And thinking about, those open-end lines of credit, student loan, mortgages, things that are really going to report for a while, because you want your average credit life to be at least 5 years generally, to give you a good look as far as a risk profile and to give you a good solid score as far as age is concerned. Now, Sean, you had mentioned a card that you have.
Oh yeah. So I have a Discover card that I got when I was like 22 years old. I'm dating myself now. But that was about 35 years ago. And so, well, about 25 years ago, I was making myself older than I really am. But I did not necessarily like the rate on it. I did not necessarily like using it, but I knew from the beginning that it was going to be important because it was the first card I ever got. And it has no annual fee. So I've kept it open. And so ultimately what is seen is that Discover has trusted me for the last 25 plus years with a credit line. And they've, as well as I do, that if you don't do right with a credit line, they'll close it down quickly. And so it's helped to continue to give me that solid foundation and keep my credit score where I want it.
Yeah, and that's probably been one of the most major mistakes that I've seen while in the industry is people, sometimes rolling credit card debt into home equity lines or balance transfers or personal loans, and then they go and close out that card. And I've seen people that'll go and close out multiple cards, and their scores. I've seen some drastic impacts from it because when you close out your oldest credit line, you dramatically shorten your average credit life, and it penalizes you.
Mm-hmm. All right, let's talk about my favorite, amount owed to the revolving utilization. And this is the one that I think has a bigger impact than people realize. And so essentially the best rule of thumb is the 30% rule. And so what you're looking at is if you have $1,000 line of credit, $1,000 credit card, you typically don't want to have more than about $300 on it. You want to keep it below 30%. The closer you get to the max credit limit, the more it impacts your credit score. And I think a lot of people don't really realize that basically as your balance goes up, your score is going to go down once you get past that 30%. And so I think that's really important that people understand that those credit limits to how much you have on it really can make a big difference in not only what your score is, but on how long you're going to have to sit with that type of score. As long as it's sitting there, it's going to continue month after month to impact you. So,
wow. So is there any way that you can use your credit cards to fix the utilization?
yeah. So I'll give you a quick example. Let's say you have $1,000 credit card, $1,000, and you have $500 on it. Doesn't seem like much, but you're still over 30%. So you're being impacted by being at 50% utilization. But let's also say that you have a $2,000 card over here that does not have a balance. You can take that same 500 and balance transfer it to that 2,000, and now it no longer impacts your credit because you're under 30%, being at 25% over there. And that's part of the way, the creativity in how we can help you boost your credit, how we can help you. Sometimes it's not a matter of what you have, it's how it's being presented to the credit bureau. So that's a great question.
You know, I like to send a lot of my clients to you because I know you mentioned you have an app that can tell you what to tell them about how
Yes.
to use those credit lines in the best way. So not all lenders have that. And I really like that about working with you.
Yeah, we have a great service where we can take your credit bureau, and it's essentially allows us to say, if we pay this down, what does that project to? If we pay this off, what does that project to? And sometimes it may be a matter of it doesn't do anything for you, and you could be
Mhm.
working towards something that doesn't even really impact your score. So yes, it's a service we pay for, but it's well worth it because it gives us a very streamlined plan on how we need to move forward with the most efficiency.
You can really pinpoint what they need that way. Great.
Absolutely.
Yeah, and another key element to this that I've seen a lot, and y'all have to forgive me here. I'm not knocking Dave Ramsey because he's got some phenomenal financial programs, but one of the things I heard a lot when I would recommend credit cards to people is Dave Ramsey says don't get a credit card, and I would always come back with Dave Ramsey's not going to finance your house, um, and that's because as in terms of borrowing money, credit cards are an absolutely awful way to do that. In terms of building credit, there's almost no better, more sustainable way to build credit than with a credit card. I would never encourage anybody to go and make a giant purchase that they're going to spend the next 5, 10, 15, 20 plus years paying off on a credit card because their interest rates are awful. But I've told tons of people, I'll see people and they're like, well, I got one medical collection and a car loan and that's it. And we'll get them a secure card and see, 100-point increase in 6 months. And that's because when they don't have a card at all, they're missing this entire 30% piece of this calculation. It's not feeding into their score at all. And as you can see, there's only one thing that feeds in more than credit card utilization. So this is absolutely essential to building credit, and it can impact it so quickly. And it's just one of those things because there's an aversion to credit cards. But what I always lead with is I would tell people, get a credit card with a small limit, buy you a soda with it every 2 months, pay the soda off and put it in your sock drawer. 2 months
Yeah.
later, buy you another soda and let it be a tool for you.
Well, and I think the thing with what Dave Ramsey's trying to say, because I think Dave's got some fantastic programs, but I think the problem that you run into is that Dave Ramsey says don't get a credit card because most people don't have the self-discipline to utilize it as the tool that it is. And that's where we're going to work with you as well, because we're going to be that little angel on your shoulder, making sure that you do the right things with it so that it can and help boost your credit score. So
Yes, and like you said, we had a buyer once. He bought a lot of things for his wife who was pregnant, not knowing that he would find a home shortly, after that, and it did influence his credit, and it made it kind of tricky for him to buy, but he got through it.
yes, and then had a beautiful baby daughter. But
Yes.
on the flip side of it, you're right. He had no idea that the two, because he didn't have a ton of credit, but the two cards that he had had gone and bought some things right before we were making the offer, and it hit his credit. We had to do some fancy footwork to get ourselves back to the position where that score reflected the way it did prior to. So, and
Yes.
this next slide I think is pretty self-explanatory, but always make your payments on time, even if it's the minimum payment. That is going to be the main section of that credit score pie, is make your payments on time. I used to make jokes with my wife and tell her that we were going to keep our credit the way it needed to be, regardless. If it came down to it, sometimes it might have been, honey, you're either going to get peanut butter or you're going to get jelly. We're not going to have both today because we got to get these bills paid. But keeping that credit score for these times when you're buying a house, the amount of money that it can save you, and having the best rate or the best car loan rate, you'd be amazed at what the difference can be long term on a car. I've seen the difference between the same car, but because there was a 100-point score difference, someone ends up paying back an extra $7,000 worth of interest. That's a lot of money you could do something else with. So make those minimum payments. There are a lot of programs out there like Experian Boost and different things that say they're going to help you build your credit. But I would encourage you again to speak to someone who is a professional who's talking directly with you, because sometimes the things that these places will tell you to do don't even impact your score.
Mhm.
And sometimes it's the simplest thing, like we said, about just transferring a balance that can give you a 30-point boost without having to put a bunch of money out of your pocket, or you just can spin your wheels a lot. So I encourage everyone, utilize the resources, the people, and the tools that are face-to-face and can talk through things with you.
I like that. Yes.
And that's one of the beautiful things about what we do is we've got some skin in the game. So we've got a stake in it. Lexington law, the longer it takes them to fix whatever's on your credit, the more it benefits them, and other places like that who charge you the monthly service charge, and not knocking them, because they do provide a service. But for us, it doesn't benefit us unless we get you where you want to be.
Right.
And it's, I'd always tell people, come, let's talk through this, because this is a service that we offer our clients. This is tied in with what we do. You're not going to pay any additional fees. We're not going to give you any guidance. And we've got one thing, which is mortgages. So we're going to help you get to where you need to be to meet your goals.
Yep. Our job is to get you in your home, plain and simple.
So if you have any questions whatsoever, don't hesitate to reach out to us. And I hope that you'll take a look at our next video that we're going to put out about the history of the mortgage rates. So
Everybody
thank
loves a
you all for
history lesson.
watching.
Everybody loves a history lesson. See you guys then.
Okay,
Thanks.
Thanks.
Great.
Bye.